Welcome to Stockcase. Today we will discuss about mutual funds. Mutual fund is one of the most popular investment option in the country. Now, what are mutual funds? Mutual fund is a kind of investment that uses money from different investors, retail as well as institutional, and in return, investors are issued with mutual fund units. The price of these units keeps on changing depending upon the performance of mutual fund. This price is known as net asset value. Mutual funds are generally issued by asset management companies and are managed by fund managers. The money collected from these investors are invested in different types of securities such as stocks, bonds, debentures, etc. in order to get some returns on investment like dividend, income, interest, etc. Performance of this investment determines the performance of mutual fund, thereby determining its net asset value. Before buying any mutual fund scheme, an investor should also compare its returns to its benchmark index and its peers. Let us see the classifications of mutual fund. Mutual funds are broadly classified into three categories: based on management, based on investment, and based on structure. Based on structure. There are generally two main types which are based on structure: open-ended and close-ended. Third one is also there, which is known as interval fund, but it is not so popular among investors. Open-ended mutual funds. Open-ended mutual funds are the funds which can be bought and can be sold or redeemed at any given point of time. There are no restrictions on the number of units issued. The asset management company can issue as many units they want. Close-ended mutual fund. Closed-ended mutual fund are those funds which can be bought only during its NFO, no fund offer, and these mutual funds are usually locked in for 3 years and cannot be sold or redeemed before maturity. Closed-ended mutual funds are listed under stock exchange, where investors buy and sell these units among themselves. Generally, these closed-ended mutual funds are highly illiquid. Based on management. Under based on management, the funds are either actively managed or passively managed. Actively managed funds. Actively managed funds are those funds wherein the fund manager and his team of research analysts actively search for investment opportunities. Actively managed funds tend to beat the index and passively managed funds as the investment opportunities are seized and capitalized. Actively managed funds charges higher fees compared to passively managed funds. Passively managed funds are those funds which tracks index or certain type of assets like gold and other precious metals. Passively managed funds run through a predetermined system. For example, index funds which tracks Nifty. This means if Nifty grows, the fund also grows with the same proportion, and if Nifty falls, the fund also falls with the same proportion. Passively managed funds charges the lowest fees as compared to other funds. Based on investment. Under this classification, mutual funds are classified on the types of investment they make. That is, equity mutual fund, debt mutual fund, and hybrid mutual fund. Let's talk about the first one, equity mutual fund. Equity mutual funds are those funds where the money is invested purely in equity securities, such as stocks and IPOs. The main objective of this scheme is to earn higher return and growth, which also attracts higher risk. Debt mutual fund. Debt mutual fund are those funds which invest only in debt securities, like debentures and bonds. The objective of this fund is low risk and steady returns, though some risks related to interest fluctuations and payment defaults are inevitable. Hybrid mutual funds. Hybrid mutual funds are those funds which invest in both equity as well as debt securities. The objective of this fund is to manage risk and also get good returns. This scheme attracts moderate risk. Different types of equity mutual fund: large cap, small cap, and mid cap funds, sector funds, diversified funds, dividend yield funds, ELSS, fund of funds. To understand what is large cap, mid cap, and small cap fund, First, we need to understand what is market capitalization. Market capitalization means total value of the company. Companies are broadly categorized into three types of companies based on their market capitalization. That is, small cap companies, mid cap companies, and large cap companies. Companies having market capitalization of below 5,000 crore are considered small cap companies. Companies having market capitalization of 5,000 crore to 20,000 crore are considered mid cap companies, and companies having market capitalization of 20,000 crore and above are considered large cap companies. This categorization changes over a period of time. For example, few years back, companies having market capitalization of 15,000 crore were considered large cap companies. But now, those companies having same 50,000 crore market capitalization are considered mid cap companies. Large cap funds are those funds which invest in large cap companies. Mid cap funds are those funds which invest in mid cap companies. And small cap funds are those funds which invest in small cap companies. The risk in investing in mid cap companies are a bit higher than investing in large cap companies. So also the returns are higher in mid cap companies as compared to large cap companies. As large cap companies has a healthy cash flow and huge reserve and contingency funds, which helps them to survive at a time of uncertainty. But the growth potential is lower in large cap companies as they have already reached to their saturation level, whereas mid cap companies has a higher growth potential and also higher failure rate due to their limited resources. Next is sector fund. Sector fund invest in specific sectors such as banking, IT, auto, pharma sector, etc. These days, many funds are focusing on IT and pharma sector as these two sectors are showing huge growth potential due to this ongoing COVID-19 pandemic. Diversified equity fund. Diversified equity fund invest in various companies irrespective of their sector or market capitalization. The main objective of this fund is to diversify its portfolio and manage risk. Dividend yield fund. Dividend yield fund mainly invest in those company stocks which pays higher and steady dividend. The stocks are called dividend yielding stocks. If you want us to make a separate video listing out good dividend yielding stocks, then please let us know in the comment section below. Next is Equity Linked Savings Scheme. It is also known as ELSS. ELSS is a tax saver scheme which invests in equity market. In this scheme, the investments are locked in for 3 years. In this scheme, the investors can claim tax exemption of up to Rs 1.5 lakh under Section 80C of Income Tax Act. Fund of funds. Fund of funds are funds which invest in other mutual funds. This fund charges comparatively higher commissions than other funds. In this fund, the risk is lower and it also offers good return, and the investment is well diversified. Debt mutual fund. The second classification of mutual fund which are based on investment are debt mutual fund. Types of debt mutual fund: Gilt fund, liquid fund, corporate bond fund, banking and PSU fund, money market fund, long, mid, short-term fund. Gilt fund. Gilt fund are debt fund which only invest in bonds and fixed interest-bearing securities issued by central and state government. This bond contains zero default risk as the issuer is government itself. Corporate bond funds. Corporate bond funds are debt funds that invest at least 80% of their capital in companies with highest possible credit rating. This credit rating is given only to the companies that are financially strong. Liquid fund. Liquid fund invests in short-term debt securities and money market instruments with maturity of up to 91 days. There is no lock-in period in this fund and contains very low risk and offers low returns. Banking and PSU fund. Banking and PSU fund are open-ended debt mutual fund which predominantly invest in debt instruments of banks, public sector undertakings, and public financial institutions. This fund contains low risk as the company in which they invest in are backed by government. Money market fund. Money market fund invest mainly in money market instruments such as certificate of deposits, commercial papers, treasury bills, repurchase agreement with maturity of up to 1 year. The third classification of mutual fund based on investment are hybrid mutual fund. As we know, hybrid mutual fund invest in both equity as well as debt securities in different proportions. There are three main types of hybrid mutual fund: monthly income plan, balance funds, arbitrage fund. Monthly income plan, as the name suggests, it is designed for the investors who want to create an alternative source of monthly income. This fund is primarily debt oriented, as over 70 to 80% of its fund are invested in debt securities. The remainder goes into equity. This is done to create a steady flow of income. Balanced mutual fund. Balanced mutual fund are mostly equity oriented and equity take up to 60 to 40% of the fund's portfolio. It is designed for those investors seeking a mixture of capital appreciation and low risk investment. Arbitrage mutual fund. Arbitrage mutual fund makes profit through price discrepancies in different markets and different segments. This fund buys and sells securities in different markets and in different segments simultaneously and makes profit. For example, if a price of a share in spot market is 100 rupees and in derivative market it is 105 rupees, this fund will buy it in spot market for 100 rupees and sell the same security in derivative market for 105 rupees.
For more videos on investment and finance, please subscribe this channel by clicking the subscribe icon below. And if you like this video, don't forget to hit the like button. Thanks for watching.